All right, so as we all navigate the new Income Tax Act of 2025, there's one area that trips a lot of people up. How do you actually calculate gains on assets you've been depreciating for years? It sounds straightforward, right? But believe me, a simple mistake here, well, it can lead to some costly surprises. So today, we're going to break down Section 75 piece by piece to make sure you get it right every single time. Let's jump right in.
Okay, picture this. It's a scenario that every single business owner or accountant has seen. You've got some old machinery. You finally sell it for 8 lakhs. You remember buying it for 12 lakhs way back when. So your gut instinct says, hey, that's a 4 lakh loss. But is it really a loss in the eyes of the taxman? Or are you maybe looking at an unexpected tax bill instead?
Well, you probably guessed it. In most cases, the answer is a big no. It's not a loss. And the entire reason why is tucked away in a very specific, very important part of the new law. This is where Section 75 of the Income Tax Act 2025 comes into the picture.
So let's talk about the governing provision itself, Section 75. Think of this as the rulebook. It's the part of the law that tells us precisely how we're supposed to figure out the cost of an asset after you've been claiming depreciation on it, maybe for years.
Now, if you're feeling a little worried, thinking, oh great, another brand new concept I have to learn from scratch, you can relax. The whole point of the 2025 Act was to make the transition from the old law as smooth as possible. It wasn't about reinventing the wheel, but more about clarifying and carrying forward the core principles we already know.
And you know what? Section 75 is the perfect example of this. This is not some new rule pulled out of thin air. For anyone who's worked with the old 1961 Act, this logic is going to feel very familiar because it's the exact same principle we saw in the old Section 50A. The section number has changed, but the fundamental idea, it's exactly the same.
Okay, so to really get how Section 75 works, we need to get comfortable with its most important concept, the written down value, or WDV. Honestly, everything in this calculation revolves around this single number.
So, what is WDV? Let's break it down. It's really simple. It's the asset's value for tax purposes. You start with the actual price you paid for it, the original cost. Then, year after year, you subtract all the depreciation you've legally claimed on your tax returns. The number you're left with, that right there, is your written down value.
This slide really highlights the most common mistake people make. Our brains want to use the original purchase price as the cost. It just feels intuitive. But it's wrong. Section 75 is crystal clear on this. When you're calculating capital gains on a depreciable asset, the cost of acquisition is its written down value at the moment of sale.
And this isn't just someone's interpretation. It's spelled out right there in the law. Now you might be asking, why does the law do this? It's all about preventing a double dip on tax benefits. See, you've already gotten tax deductions for years through depreciation, which accounted for the asset losing value. The law says you can't also claim a capital loss on that same drop in value. It's a fundamental part of tax fairness.
Okay, theory is great, but let's make this real. Let's move from the legal text to a practical step-by-step calculation. We'll use our first example to see how this all works with actual numbers.
So let's walk through it. The machinery originally cost 12 lakhs. Over the years, let's say you claimed a total of 5 lakhs in depreciation. Simple math, 12 minus 5 leaves a written down value of 7 lakhs. This is your new cost for tax purposes. Now you compare that to your sale price of 8 lakhs. And just like that, what looked like a loss is actually a taxable short-term capital gain of 1 lakh. See how that works? And here's another super important detail you can't forget. When this asset is part of a block of assets, grouped with similar assets for depreciation, any gain you make on its sale is always considered a short-term capital gain. It doesn't matter if you've owned it for 10 days or 10 years. It's short-term. And that, of course, has a big impact on the tax rate you'll end up paying.
So, understanding the rule is step one, but applying it correctly and making sure you're compliant, that's the real challenge. Let's talk about the practical side of things and the common mistakes you need to avoid.
First things first, your record keeping has to be perfect. There's no way around it. You need accurate, up-to-date depreciation schedules. Without them, you can't calculate the correct WDV. The biggest mistake we see time and again is people defaulting to the original purchase price. Don't do it. And finally, always remember to classify the gain correctly as short-term.
All right, we've gone through the law, we've done the math. Let's boil this all down to the absolute key takeaways you need to have locked in. If you remember just 4 things from today, make it these. 1.
For depreciable assets, cost equals WDV, period, not the original price. 2. This rule isn't new, it's just a continuation of the old 1961 Act. 3. Any gain is always treated as short-term. And 4. None of this is possible without precise, up-to-date documentation. Get these 4 points down, and you've basically mastered Section 75.
And that's our deep dive into Section 75. I really hope this helped clear things up on this very important provision. Thanks so much for watching. If you found this useful, please do us a favor. Like, subscribe, and share it with your colleagues. We'll see you in the next explainer. Just a quick reminder, this content is for educational purposes only. It is not professional advice. Tax laws are always changing, so please consult with your professional advisor before making any decisions. This was an AI-assisted production.